Okay, so let's talk about one example of how exactly we use the balance sheet variables to predict a price, like we did for income statement. And I told you guys it's theory-based. We use theory-based ways to do that. And so let me talk about the theory first, and then you can see how we test the theory. Okay, you guys remember before the break we said we have two approaches. One is theory-based approach to analyze the data. Another one is machine learning-based approach to analyze data. We focus on let's do the theory-based for most of the analytics. We will also talk about the machine learning-based. So since it's theory-based, let's look at what theory we have. What theory we have to analyze the balance sheet. So the theory what we have here is there's an agency problem between managers and the investors. You guys all understand that investors owns the company. Investors own the company, but managers run the company. So there's a separation between the control and ownership. So it's like your friend is running, you're doing your homework. Basically, the grade is yours. Your friend is doing homework for you. He's doing the homework, or she or he is doing the homework, but the grade belongs to you. So you have more incentive for higher grade, but actually you're not a person doing the homework. So this is like typical agency problem. So what's the problem here? That we can use the balance sheet information to predict the stock price. The theory we have is managers, they intend to empire building a company in order to get more control. So for example, a company, a manager, if I'm a CEO of a company, I want to hire more people so I can control more people. I want to buy more houses, assets, department. I want to expanding the company because originally I only can control 100 people, but I can control 10,000 people. I want more control of the resource. And why I want to do that? Because the money is not mine. I'm using shareholders' money. I'm using borrowers' money to expanding my source, to expanding my resource. So there's an agency problem here that that the managers using the house money to expanding the firm for their own controls, and that's the problem. And another problem is investors do not know what the managers actually what they're doing. Like taking an example back, you have your friends doing homework. If you can really do the homework, why you have your friends doing it? The reason you have your friends doing homework because you don't know how to do the homework. But can you really close monitor your friends? Really, is he or she really doing the homework right or wrong? You have that information asymmetry. So that's the problem here. The problem is the following. So investors give the money to managers, and the managers use other people's money to expanding their own resources. This is problem one. The problem two, the investors cannot exactly evaluate the manager's action because the information asymmetric. They cannot exactly manage the manager's action. They cannot evaluate the manager did wrong or right or wrong. And also the managers have the incentive to expanding the firm for their own purpose, not for the shareholders' interests. So all these together, what we found is if a firm have extreme asset growth, the firm will experience negative return in the future. So that's what we have experienced when we analyze the data. Let me repeat one more time. So what we from the theory is what? From theory, what we have is if a firm has extreme asset growth, I put extreme here because just a little bit growth is fine. If a firm has extreme asset growth, and the firm will experience future negative performance, sales, and also have future negative returns. So that's the that's the Cooper have done for the balance sheet analysis. So the bottom line, this is, I said this is theory driven, right? Theory driven. So let's just putting down a theory here. What's the theory? The theory is, if a firm experiences extreme asset growth, that means the manager is doing empire building. That means the manager is using shareholders' money to expanding for his own control, and the firm has negative sales and performance and stock returns in the future. That's the theory we have, and we are going to test it. How we test it? So you can see that this is the table you guys see from the reading. What we have here is what we have here is the assets here. The assets here is the asset growth, and the asset growth. What does this variable mean? This variable mean here is, if a firm have extreme asset growth, what's the dependent variable here? Dependent variable here is the stock return of next year. So basically, the idea telling you is, if a firm has extreme asset growth, the firm will experience negative stock returns in the future, in the next year. And so we have the theory, we have the test. We have the theory of test. The theory is, when they may do empire building, they may have future negative returns than stock price. And the test is, we did show that we did not meet Cooper and the Fairfield. They did show that the asset growth predict future negative sales and predict future negative returns, and everything is negative here. So this is what one simple way. This is one simple way you can use the balance sheet to predict the future stock price. And we have a theory as a backup, right? The theory is here because the managers using the house money to bet the game, and so that's why the asset growth here predict the future negative stock returns. And then so what do we do? What can we? So this is the story I want you you guys can think about your own. How can we improve on that trading strategy? We already know that high asset growth will predict future negative returns. We know that, but you cannot just every time you follow other people, right? You have to create your own strategy. How do you create your own strategy from this example? I just want you to know how the literature evolves. So here is the very interesting decomposition of asset growth. So asset growth can be decomposed into different components. The asset growth, you can, when the company is growing their assets, there are different way they can grow their assets. The first one is they can borrow money from investors. They can get money from investors and the bank and the bond market to grow their assets. That's one way. The other way is they can borrow money from vendors, suppliers, to grow their assets. So there's two different ways to grow their assets. So that's why we have here, it's the operating net operating assets or the operating liabilities. So we have two different ways to grow the assets. Let me explain in more details what does that mean. So let's say if just take a company, Coca-Cola, and let's use another example. Let's say if Amazon purchased a lot of warehouse. You guys know the Amazon, they have a distribution center. They have a lot of warehouse. They have the auto robots deliver the shipment to the neighborhood. So let's say I'm Amazon. I want to purchase the building as my warehouse, but I cannot make a payment for the building once. I maybe pay the building for 10 years. In the 10 years, I have a 10 years payment to finish pay up for the building. So in that case, let's say the building is $10 million. It's $10 million each year. Amazon pay $1 million to the seller of the building for the payments. So in that case, the first year Amazon paid $1 million, and Amazon will pay another $9 million to the seller of the buildings. That $9 million is actually the money the seller of the building lent to the Amazon. Does it make sense? Does it make sense? So basically, when Amazon didn't pay the building in a full amount, when Amazon spent 10 years to pay the payments for the building, the later payment is actually, that's the liability to Amazon. That's the money the building sellers lend to Amazon. So in the case I just explained, if the building is $10 million, when Amazon paid the first year $1 million, the rest of $9 million are actually the money the Amazon, the building sellers lend to Amazon. So this is one way Amazon can grow, right? Amazon can grow by purchase a lot of building, but can only make first payments. The future payments will be the liability to Amazon, will be the money Amazon borrowed from the sellers. So there's another way Amazon can grow. Amazon can do what? Amazon can borrow money from bank and then purchase the building in a full amount. The Amazon can and issue more stocks in the stock market and use the cash from the stock market to purchase the building in a full amount. And Amazon also can issue bond and use the bond to purchase the building in a full amount. So you see that. So you see the two options I was talking about. So Amazon has the two options to purchase the building. Either Amazon can get the cash from the stock market, bank loan, or bond market to purchase the building in the full amount. That's one way, right? Another way is the Amazon can actually make installment payments, like 10 payments, and the rest of payments will be liability to Amazon, money lent from the sellers. So what I'm trying to say here is, where is the money from may matters a lot to analyze the balance sheet. Why is that? Why is that? The theory that we said this is a theory. We want to talk about a theory. The theory is the previous study, we only talking about the managers. They want to expand in the firm. They want to do something bad. That's the original theory. But what we want to add here is, it depends. It depends where is the money from. If the expansion is from the money from the sellers, from the suppliers, this may be good expansion, good growth. But if the money is from the stock market or bond market or bank loan, it may be bad expense, like growth, what we did before. So that's the theory we want to propose here. What's the theory we want to propose here? So why we do have that theory? The reason is the following. The reason is the following. So sometimes you may be wondering, where's the theory from? The theory, you need to talk to industry people. So when you talk to a lot of vendors, suppliers, you will immediately realize there's a lot of information like you cannot get from reading the textbook or the papers. So I personally get a lot of ideas and theory from the industry people. I talk to them, I exchange idea with them, and I get something very interesting, and I use data to test it. This is something you can do as well. You can talk to, that's why I have industry speakers come in. They may have give you some ideas, but you have to test it. You have to data test it. You test that is correct or not correct. So this is the idea I got from talking from the industry experts. So what they told me is, let's say the building sellers. The building sellers, they will not lend money to Amazon if they believe Amazon is just abuse the cash. They just abuse the growth of the firm, because the building vendors, they cannot afford Amazon to not pay them back. So when the building vendors, when the building sellers trying to lend the money to Amazon, they will be extremely careful. So versus bank has a huge loan portfolio. If Amazon cannot pay back, it's fine. They can wait. They can wait for late payments. Bank has the flexibility to afford the late payments. But most of the commercial, for most of the building or the vendors or suppliers, they cannot afford taking later payments, otherwise they will go bankrupt. So so that's the insights I got from a lot of industry experts. They said when the suppliers and the vendors, when they trying to financing their buyers, they will be extremely careful, because they cannot afford later payments. That's the reason one. That's the reason one vendor, supplier, and the vendor financing and the supplier financing, they have more careful review process than banks and other firms. That's the reason one. The reason two is when the vendors and the suppliers evaluate Amazon, the evaluation is in a very natural process, versus bank and the investors, they trying to evaluate the Amazon. It's more of a format or more of a presentation of good information. So let me give you an example. So the vendors and Amazon, they have a natural business transaction. They can know each other well in a very natural way. And so they know each other from the very natural business transaction. So all the information are authentic, are truth. Versus bank and investors, when they trying to investigate Amazon trying to present only the good side of the information to this bank, to these investors. So there's a lot of information hidden there, and this is a risk for the creditors. There's a metaphor we can use here. Let's say if I borrow money from my friends and borrow money from my bank, which one would be easier? I know this is sometimes is easy, not difficult to say, but normally, why borrowing from my friends signal I'm doing a good thing? Borrowing from bank signal I'm not doing good thing. So let's say you are my friends, and let me pick up a name here. So let's say Jintai. Jintai is my friend, right? I said, hey Jintai, can you lend me some money? I'm going to do something good. So since you are my friends, we have a natural business transaction together. If I do something bad, you will tell me, say, hi professor, I'm sorry. I mean, I cannot afford that. And you are doing something I don't understand. You are doing something which I don't think will work. Can you just forget about the idea? So because we know each other from natural transaction, and so he can evaluate my how I spend the money in a very natural way, in a very transparent way. Let's take about another scenario. I borrow money from bank. I ask a bank manager. I say, I want to borrow some money. So how am I going to present myself to the bank manager? I'm going to present all the good things. Oh, this is my income. I have a house. I have a nice car. I present all the nice information to the bank managers. And I can also at the same time I hide all the information I'm concerned about. So in that case, so who get better information from my future project? Is that my friend Jintai or is the bank manager? In most of the time, it will be Jintai, because he has more of a transparent way to evaluate my future project. Versus bank manager, there's a lot of hidden information there. So that's the story. That's the theory I want to share with you guys. So the story, what we have here is, we want to say that the old analytics of the balance sheet saying that as long as the manager has extreme growth, the manager is doing something bad for the investors. Everything is bad. So what we want to say here is, wait. Hold a moment. We have to. There must be some good managers. There's some bad managers, but good managers. We cannot just one size fits all. We cannot just say everybody is bad, all growth is bad. We have to see who are the good managers, who are the bad managers. And the way we're trying to distinct them together is by looking at where's the money from. If the manager's expansion plan is from the vendor's financing, is supplier's financing, and then we say this is a good manager growth. If the manager's growth borrowed from a bank, stocks and the bond market, and we found this is the bad growth we are talking about. So here is that's the twist. That's the twist. We have trying to add more to the balance sheet analytics. That's the idea. I want you guys always think about on your own. When you heard the first idea, can you get the second idea? When you heard the second idea, can you get your own idea? Like I said, you guys are finance major. Your parents must expect you guys to provide some investment tips for them, right? So how you guys, you have to come up with this kind of idea by talking to industry people, by reading the material I gave you guys, by doing some data analytics. This is the homework you have to do behind. So just to summarize what we have here is, we cannot say all the managers who are doing growth, extreme growth, are bad. We cannot say that. We must to identify some managers who are doing a good job for growing the firm, who are doing a bad job for growing the firm. For those who are doing a good job, we look at where is the money from. If the money from suppliers, they are doing good job growing the firm. If not, they are doing bad job from the firm. And the theory is as I explained, because the suppliers, they know more about the managers. They can evaluate the future expansion plan of the managers. If the manager are doing something bad, terrible, suppliers will not willing to lend the money to the managers. If the suppliers are willing to lend the money to the managers, that's a signal. That's a signal to the market. If I can borrow money from all of you guys, then that's a good signal. That means you guys admit I'm doing something good, right? I'm doing something good. So this is the theory behind that. We want to differentiate good managers from bad managers in terms of growing the firm. And then this is the theory. And what's next? You have to test it. Okay, you have to test it. Like I said, you cannot just say, oh, this is theory, done. And for every single trading strategy, you have to test them rigorously. This is about money, and this is about money. It's about your money and the investors' money. So you have to be very careful about all these theories. You cannot just say, oh, makes sense. Yeah, professor, what you said makes sense. That's you guys true. Let's do it. Let's put the money in. You have to test it. You have to do a serious testing. You have to calculate abnormal return. You have to calculate risk. You have to do the rolling regressions. You have to do the pharma MacBath regressions. You have to test it. Okay, how exactly we can test it? So so we have to let's explain the way we can test the theory. Yeah, when you guys review the slides, you can see like most of the contents I put here. So for example, the suppliers know the Amazon better because they have a natural transaction. They can have side visits, and also they cannot afford late payments. All these summaries I have put on the slides. So okay, so how exactly we can test it? How exactly we should test it? The way we test it, have two steps. Okay, the first step is you have to calculate the growth that is financed by the suppliers, and you have to calculate the growth that is financed by the shareholders, bank loan, and bond investors. So number one is you have to construct the growth, the different growth in order to do the testing, right? Do the testing, because the theory here is original theory is all the growth is bad. As long as the growth is bad, what we want to tell is if the growth is financed by suppliers, good growth. If growth is financed by the other is bad growth. So you have to calculate this measure. You have to calculate this measure. So in the reading I gave you guys, I give you the details, the formula, how to calculate that. The calculation is straightforward. It's straightforward. Basically, the idea is we have 250 variables out there. You use the 250 variables, you do the combination of the theory, you can always calculate what you want. So you use the variables I gave you guys, you can calculate the growth that is financed by suppliers. You can also calculate the growth that is financed by investors, bank, and shareholders. So you can separate the two growths from each other by using the 200 variables I just showed you guys moments ago. That's the idea of data analytics. You can use the variable I gave to you to calculate these useful measures, the signals. And then once you calculate these variables, you have to test. You have to test the return, whether it has the future stock returns in terms of can it really predict the future stock returns or not. That's something you need to test. So so this is the number one. Step one is to calculate the measure. Step two is to using what we discussed last video to test whether you can predict the future stock price. And so here let me show. Let's do step by step. Let's do step by step. Let's do the let's consider two measures first. The first measure is what? The first measure is the total asset growth. The second measure is the NOA growth. Let me just give you an idea what the two growths mean. The total asset growth is the growth financed by everything. That's the growth financed by, as long as it's the growth, it doesn't matter where's the money from. The total asset growth is the growth of the firm financed by everyone. That's the total asset growth. The second growth is what? It's NOA growth, net operating assets. What does net operating asset growth mean? That's the firm growth financed by shareholders, bank loan, and bond market. Okay, bond market. So these are the two growth measures. These are the two. So in the paper I gave you guys, I give you very detailed way to calculate this growth. You can look at the formula. You can look at the formula in the paper to understand that. But I want to give you guys the idea of what does that stand for. Let me repeat it one more time since it's an important concept. The total asset growth, that means the growth financed by everybody. The NOA growth, that's the growth financed by shareholders, bond, and bank loans. So looking at these two types of growth, what idea you can get? Which one will predict future? Which one will be more associated with future negative returns? Is that NOA growth or is total asset growth? I think you guys have the answer, right? You guys have the answer. We think the NOA growth will be associated with future negative returns more than total asset growth. The reason is because the NOA growth is financed by those shareholders bond market, so it's purely bad growth. Versus total asset growth, it contains good growth and bad growth. I just want to make the big picture clear to you. The total asset growth contains both good growth and bad growth, versus NOA growth only contains growth that is financed by the shareholders bond market. So NOA growth will be more associated with future negative performance and stock returns comparing to the total asset growth. So that's the theory we have here. That's the theory you have here. Let's test it. Let's test it. Hopefully everything is clear here. Everything is clear here. Okay, so let's look at how we test it. How we test it. So let's look at the regressions here. Let's look at the regressions here. We use the NOA growth. Can you guys see my mouse? Good. Okay. We use the NOA growth to predict the future ROA. ROA is return on assets. It's like earnings, right? It's a fundamental performance. We use the total asset growth to predict the future ROA. We use the NOA growth to predict future returns. We use total asset to predict the future returns. So let's look at ROA first. You can see that total assets growth predict the future performance. Good, in a good way. So basically, total asset growth can actually predict the future negative growth. There's a negative sign missing here. There's a negative sign. This should be a negative sign. It's missing. Just you guys, there's a typo. Okay, the sign missing here. And then let's look at NOA growth. NOA growth can also predict the future negative earnings, but in a more stronger way. So you look at the coefficient. The NOA, everything is scaled. The TA growth and NOA growth, everything is scaled. So you can compare them directly. So basically, when you moving from the bottom decile to the top decile, the total asset growth can predict negative future earnings by 2 cents. The NOA growth moving from the negative bottom decile to the top decile can predict negative earnings for 4 cents. So you see the magnitude is different, right? Magnitude is different, and also t-stat is also different. That means it's consistent with my theory. Consistent with that NOA growth is more negatively correlated with future performance compared to the TA growth, total growth. And the reason is, like I explained before, because the NOA growth is purely financed by the investors, the bank loans, versus total asset growth has good growth and bad growth. The total asset growth has good component and bad component. So that's why the NOA growth can predict future negative return and sales in a more stronger way, with 4 cents and a higher t-stat, versus total asset growth 2 cents with smaller t-stat. So I hope that's clear for you guys. This is something you need to, that's the project you guys doing. You guys are doing. It's a simple, right? It's an easy project, and you horse race the two variables together, and you find that only NOA growth loads, the TA growth do not load. That makes sense, right? Because the TA growth contains good growth and bad growth, versus NOA growth is only about the purely bad growth. So when you horse race the two variables together, only NOA growth loads, the TA growth do not load. So that means the NOA growth is the actual bad growth here, drives the negative returns. So that's for the future ROA. That's for the future ROA. I told you guys, whenever you test the market inefficiency, you have to do two steps. First, you have to test whether the variable predicts the future performance, sales. The second step is, do investor get it? Do investor actually understand this? So what I'm saying is investors. What I'm saying is NOA growth can predict the future. Take it back. What I'm saying here is NOA growth can predict future negative earnings. Is that some information only you know, or is the information everybody know? You have to test that. You have to test that, right? So you already show that the NOA growth can reduce 4 cents of earnings in the future. You show that. That's good. But is that 4 cents of earnings reduction, is that something you only know or everybody know it? So you have to test that in the future abnormal returns. So if everybody knows that information, the NOA growth should predict no returns in the future. Does it make sense? If everybody know NOA growth will depress 4 cents of earnings in the future, if everybody know that, you cannot, if you use NOA growth to predict the future stock returns, there will be no returns. Nothing will show up. Nothing will show up, because everyone will price the NOA growth in a very timely way. So when NOA growth can predict the future stock returns, only you know about the information. Other people do not know the information. So, and then in the next year, people gradually learn about NOA growth. Actually, it's a bad thing. It can depress future earnings. If if other people takes time to understand the information you know now, you can use the NOA growth to predict the future negative returns. That's the idea I explained in the first sessions. I don't know if that's clear for you guys. I know it sounds a little tricky, but this is fundamental for the market efficiency. Okay, let me just repeat it one more time in case some of you guys still confusing. For the future ROA test, we show that NOA growth can depress future earnings for 4 cents. That's the information we test. This is for sure. And then the second test we are doing is, are you the only person know that information, or everyone else know that? If everybody know that, when you use the NOA growth to predict the future stock price, you should see no returns, because the NOA growth is priced in an efficient way, in a timely way. However, if you know that information, other people takes 1 year to know that information, and then in the future year, you can get the returns from the NOA growth, because you buy and sell of the NOA growth ahead of other people. When other people do not know the information, you already buy. When other people do not know the information, you already sell. So because you know the information, other people can know a year later, so you can buy and sell ahead of other people. That's why you can realize the returns here. So that's why we always have a 2 tests. You test the fundamental first. You use the signal to predict the future fundamental sales and earnings, and then you use that to predict the future stock price. If you don't see any results on the future stock returns, that means the information you tested in the ROA is already efficiently pricing. If the signal you can predict, the signal you use can predict future stock price, that means you are knowing something other people do not know at that time, and other people takes a little longer to understand the signal you produced from the balance sheet. So this is the test. You have to test it. Like I said, you cannot just just touch your head saying, okay, this is good theory, I like it, let's invest. This is you have to do the rigorous test to show that whether this kind of can generate a future profit for the investors. So let's look at these tables one more time. Okay, so the total asset growth predict the future negative return. Next, buy and hold 1 year. Okay, the abnormal return here is buy and hold 1 year. So annual return is about 9%. And then you buy and hold. If you use NOA growth, it's buy and hold 13%. It's about 13%. So what does that mean? This signal is consistent with the theory we talked about before. The NOA growth is purely bad growth that the managers doing empire building, financed by shareholders from the banks. But the total asset growth is a combination of good growth and bad growth. So so you don't see much from it. You don't see much from it. That's why we have the NOA growth. We have the NOA growth we have the NOA growth from the equation. The NOA growth generate higher returns than negative returns than the total asset growth, and you horse race them together, you run them together, you find only NOA growth loads and the total asset growth do not load. Is that consistent with the ROA as well? We see in the ROA only the NOA growth load and the total asset growth do not load. Same thing here. When you predict the future stock returns, we have the same pattern. So here we get the test. What does the test tell you? The test tell you that consistent with our prediction, NOA growth is the bad growth. When the growth is purely financed by the investors, bank loans and the bond market is bad growth. The total asset growth contains of good growth and bad growth. It kind of supports the argument. And we also can run this. We also can run this separately. You can see that you can run this separately to see that the returns are different from each other. You can see that when you control, because you have to control for other variables. When you control for other variables, you can see that the returns are also, one is stronger than the others. Yeah. So let's keep moving. Let's keep moving. So what's this for? What's this for? So this is methodology you have to learn as a finance major. You need to learn what is portfolio and the double sorting and the sorting. So so this is something you guys need to learn when you do the test. So let me explain the portfolio sorting and the double sorting to you guys. You see what's the idea behind. Okay, so what does this table mean? So what do I mean by you have to sort the whole stock? So each year in the US we have about 5,000 stocks. We have 5,000 stocks, and then what do? So you sort the stocks based on NOA growth. This is a quintile, and also you sort the stocks based on total asset growth. This is quintile sorting too. And then so each of the cell here represents all the stocks that's under the low NOA growth and the low total asset growth. So each cells here is the stocks fall into the category of the NOA growth and the total asset growth. So let's take an example here. So what does the stocks here mean? Stocks in this cell means stocks here have low total asset growth and a low NOA growth. That's the portfolio we have here. So what does the portfolio we have here? The portfolio we have here, that's the stocks which have high total asset growth, and also high NOA growth. Okay, that's the stock portfolio we have here. And we also have a portfolio here. What's the portfolio here? The portfolio here is the stocks, the group of stocks which has low total asset growth and also high NOA growth. Make sense? Let's look at here. What's the stocks? What's the number of stocks here? The group of stocks here is the stocks which has high total asset growth and low NOA growth. Okay, that's why we buy two by two sorting. We buy 2 by 2 sorting. This is a very important test for you guys when you guys do the trading strategy. Why is that? Why is this important? The importance of this is because let's look at the rows. You guys can follow my mouse, right? When I move my mouse, you can see that. Okay, so let's look at the first row. Okay, first row. So when the total asset growth is low, when it's low, you can still see the variation on the NOA growth. So in that case, when you're holding the total asset growth constant, if you use a high NOA growth minus low NOA growth, you obtain very high future returns. Same thing, if you're holding the total asset growth constant, you use the high NOA growth minus low NOA growth, you obtain high returns, even if you hold NOA growth constant. Does that make sense to you? Okay, let's do the opposite. Let's holding the NOA growth constant. Let's look at this one. When you hold the NOA growth constant, you use the high total assets growth minus low total asset growth. Did you find any returns? You don't. Look at here. When you hold the NOA growth constant, you use the high total asset growth minus low total asset growth. Did you see any returns? You don't. So this 2 by 2 sorting kind of tell you who are the boss. Who are the boss, right? So basically you can tell if we hold total asset growth constant, if you variate the NOA growth, you can get abnormal returns. But if you hold NOA growth constant, if you variate the total asset growth, you get nothing. So who is the boss here? Who is the boss here? Obvious. The NOA growth is the boss here because when you holding the total asset growth constant, the NOA growth works. When you hold the NOA growth constant, TA growth do not work. So the 2 by 2 sorting, it's a very typical way for you to tell who are the boss. It's the horse racing tool. Like you can tell who actually drives the results. So I want you guys to be able to do that. Okay, I want you to do that. So by the way, when I give you guys the project I give you, I just want to explain. I already give you the variable total growth, NO growth. So I already give you all the variables. Because I feel like I don't want to. So actually, there's two steps to calculate these variables. First, you should use the original balance sheet variables to calculate total growth, and then you use total asset growth to do the table. There should be two steps. I already give you the calculated total asset growth, NOA growth. So you kind of save you guys a lot of time. All you guys need just to do the regressions and do the sorting. You guys to yeah, that's the project I give to you guys. So basically if you want to do the original calculation, you have to use the original variables to get all this asset growth. So basically, like I told you guys, the balance sheet I show you guys has 250 variables. So the first step is you use the 250 variables, some of them, to calculate total asset growth, NOA growth, these all growth. So that's the first step. I just want to let you know I have done that for you. Okay, I've done that for you. So so you have all the variables ready, total asset growth and blah 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 ready in the data set I give to you. So all you need to do is to use the variables to run the regressions and to do the sortings, to understand the double sorting and stuff. But I know some of you guys are really good. Like last time, you guys have people who can do the PyTorch, TensorFlow. You guys, some of you guys can understand the regression very well. So if you are really want to more advanced project, I encourage you guys to do the calculation on your own, right? So basically, what I'm telling you is, for the class, I gave you the variable of total asset growth. I give you the net growth. I give you already the variables to you already. But if you want to construct on your own, it's up to you. Just do it as a practice. Okay, I will not grade it. I will not grade it. I will not give you extra bonus, blah blah. Just because some of you guys kind of impressed me in the class. If you guys want to do that, go ahead. Okay, go ahead. For the whole class, you have the TA growth variable, you have the NOA growth variable, you have that variable ready. So you just run the regression and do the sorting. But if you want to calculate the total asset growth, NOA growth, everything on your own from the scratch, from the original variables, do it. Yeah, I like it. Okay, I like it. So they just want to give you some ideas of what is going on here. And so let's look at this is double sorting. This is double sorting. And we also use that to predict the short-term window. Do you guys remember last sessions I tell you guys why we want to do short-term window? Do you guys remember? The reason is because if you buy and hold for 1 year, there's a lot of risk. There's a lot of risk. You don't know the 10% of return is from the regret, is from the signal, or it's from the risk. But the short-term window is 3 days. How many things can happen in 3 days? Relatively less, right? Relatively less. So if you can get the return from shorter window, that is good. That is good. That means you can really gain money from the trading strategy. That's why if you really want to recommend the trading strategy to your parents, do not just simply do an annual buy and hold. You have to do really regular. You have to do buy and hold 1 year, to do 3 day, to do factor adjusted, to do portfolio sorting. After you've done everything, and tell everyone that's what I recommended. You know, you don't want to give reckless decisions to your friends or for your relatives, so you can do a more rigorous test. So here you can see that for the 3 day return, this is about 1%. This is about 1.8%. Do you know this is huge? This is huge. This is only 3 day return, buy and hold 3 day. And I take it back. Actually, it's not 3 day. So what we did is this is the 4 of 3 days. So it's the 12 days return. Okay, I take it back. This is 12 days return. So basically, we combine 4 3 days return together. So this is 1% from 12 days return. This is 1.8 from 12 days return. But this is huge. Think about it. You buy and hold for 12 days, and you get 1.8% after adjust for the risk. That's a huge. That's huge. So this is very confident. This is something, it's not risk driven. It's something there. This is something tradable. It's something tradable. That's the that's something tradable you have. So this is the trading strategy. Like I said, you cannot just do one simple regression. You have to do the buy and hold 1 year, 3 days, factor adjusted, portfolio sorting. So this is the factor adjusted. So what do you adjust the factor for? You do pharma French. This is 3 factors, and this is 4 factors. So basically, this is double sorting. I explained double sorting, right? So in each portfolio, what do? You do the 3 factor adjustment. You take out the risk premium from the 3 factors, and this is the alpha. So each cell here is the alpha, and then you can see the alpha is significantly low. It's significantly low. This is something you need to do too. So you are not just doing you do a lot of risk adjusted. So this is a double sorting. Double sorting. I don't need to repeat double sorting one more time. So the only difference between here and over here is you do risk adjusted. This is a 3 factor adjusted alpha. Here is a 4 factor adjusted alpha. And how to do that? You can read the paper I give you guys. I think I give you guys detailed description how to do the risk adjusted alpha. How to do the risk adjusted alpha. And this is something you guys already learned from some of your classes. So the idea here is the strategy works for buy and hold 1 year. Works for 3-day short window. It works when you adjust for pharma French 3 factors. Works when you adjust for 4 factors. It works. So you think about all the ways that could affect the risk and the skills and the signals. Every single test, if it works, it gives you the confidence. That's something really working. That's something really working. So you have to do a very rigorous test to test this strategy. And I want you guys to be able to do this kind of stuff. And like I said, I already give you the NOA growth, IETL growth. So the variables I have calculated for you. Yeah. Then okay, let me finish up, and I can open up to questions for you guys. I saw great questions. Let me finish up, and you guys can raise questions on what do we have here. This is the strategy. This is a strategy we want to test. So basically, the steps here is first you have the theory first. You have the theory. You can talk to the industry people. You can observe the data pattern. You have a theory first, and then you test it. When you test it, you have different ways to test it to make sure this is really profitable trading strategy. This is a really profitable trading strategy, and section. So today, what we are going to do is we are going to dive into the details. How exactly we calculate the asset growth financed by vendors and suppliers? How exactly we can calculate that? You guys remember last session, I show you guys 250 different variables from balance sheet and income statements. So it's there's a huge volume of variables available there. So today, let's explaining how exactly we use these 250 variables or part of them to calculate asset growth financed by vendors and suppliers. How exactly we do that? So you guys can find a formula in the paper. The formula in the paper, you can see that. Today we are focused on intuition. Like you can follow the formula easily, but we want to understand the formula, understand the intuition. So this is the first thing we want to do. We want to discuss how exactly we can calculate the asset growth financed by vendors and suppliers. And I want you guys not just memorize the formula. I want you guys understand the formula. That's what we are going to discuss for the following couple of minutes. So let's look at the formula here. You guys see the screen well? You guys see the screen? Okay. So let's look at this. Let me make it smaller. So operating growth is basically asset growth financed by vendors and suppliers. That's the same thing. Just we label as operating growth. So let's see how we actually understand the calculation of the asset growth. Basically, how you understand the 250 variables and use that to construct the signal which can predict the future stock returns. So asset growth is equal to two stuff. Asset growth is equal to growth financed by vendors and suppliers, and also growth financed by debt, equity, and the bank loan. So you can first break down the growth into growth. Let's say growth. You can break down growth not financed by debt, equity, and the bank loan, and growth financed by the debt, equity, and the bank loan. So that's added together. That's asset growth. Okay, that's step one, right? We break down the asset growth into growth financed by debt and equity, and the growth not financed by debt and equity. That's step one. Okay, let's do step two. Step two is among the non-financing growth. Among these, we further broke down. We further broke down three things. The first, operating growth. That's the asset growth financed by vendors and suppliers. That's what we need. We also have the growth financed by accounts payables, and we also have the growth financed by tax liabilities. So let's understand these three components together. What does these three mean? What does three mean is when company growing, when companies experience growing, when it's not financed by debt and equity, it can be financed by the three sources. One is financed by vendor and suppliers. That's what we want, right? And another thing is it can be financed by the accounts payables, and also it can be financed by the tax liabilities. So it can be financed by the three stuff. So why we want to take out, we deduct the accounts payable finance and the tax liability finance from the equation. Let's discuss the intuition. Let's discuss the intuition behind the measurement. So why we want to take out the accounts payable liability? So what's accounts payable for? Accounts payable normally is the payment, the credit on inventories. So in other words, when a company trying to get financing from suppliers and vendors, there are two types of financing. One is short-term assets, like inventories. Inventories is like a very short-term assets. Another one is long-term assets, like buildings, equipment, like huge assets. So here, we only retain supplier financing about the long-term assets. We kind of take out supplier finance about the short-term assets, like a inventory financing. The reason is because we think the short-term asset financing, suppliers do not put too much consideration into it. It's a very small amount. It's more of a routine contract. They don't take it too serious. For suppliers, do not take it too serious when they trying to finance the inventories. However, when vendors and suppliers, they finance buildings, equipment, this big stuff, they are more serious about it. Like the reason I'm talking about, the amount is huge. They cannot afford the later payments. So that's why we take out the short-term financing from the suppliers and vendors. We only keep the long-term financing from supplier and financing. That's why we want to take out the signal in. That's one. That's the theory. That's the theory. And also why we don't want a tax liability. Tax liability means what? Means the government allow you to pay tax in a late fashion. So basically, the company, the government kind of allow you to make a late payment on tax, or give you tax credit. That's tax liability. That's not clear, because why some firms don't want to pay tax in advance? Maybe the company is doing well, maybe the company is doing very bad. So the story is not clear. Why the government want to financing the firm and allow the firm to make a late tax payments? It's not clear, because it may be a good thing. Maybe the government think wow, the firm is doing well, so you can pay tax late. Maybe that's the good story. Maybe the firm have like a bad cash flow, they cannot make tax payment. So that's why when we calculate the asset growth by vendors, we take out two components. If it's a short-term assets from the if it's inventory, if it's short-term financing from vendors, we take it out. If it's financing from government regarding tax payment, we take it out. So that's the story we have. Some of you may wonder, ask me, hey professor, what you said may be correct. What all you said makes sense. You want to take out the short-term financing from suppliers because you believe short-term financing is not a serious deal for suppliers. Long-term financing, it's more expensive, it's a huge amount, so suppliers will put more evaluation on long-term assets, and it sounds makes sense. And also for the government, when government allow the tax financing or not tax financing, it's not clear. So you may agree with me. The theory wise, it may make sense, but you may also question me. How do I know it for sure? Like how do I know this is exactly what is happening? So my answer is, if you are not sure about theory, you need to test it. You need to test it. So in other words, you can test whether the operating growth can predict the future stock returns. You can also test without taking out the two components. Do they also predict future stock returns? If my theory is right, you will see that the operating growth will predict stronger future stock returns. If my theory is wrong, then you don't take them. You can without taking out the two components, you can still predict the future stock returns. So what I'm trying to say here is, we have to, data speaks themselves. We have to data speak them. First, you have the theory first. My theory is short-term financing, not good. Government financing about tax, not good. This is my theory. Then, if you don't trust my theory, you test it. So how do you test it? You take them out to see whether operating growth predicts future returns. And then you don't take them out to see if the together component predicts future returns. If taking them out can help you to predict future stock returns, my theory is correct. If without taking them out, you can predict future stock returns, then something wrong with my theory. So that's how exactly you guys can think about the project you guys are going to do. By the end of the semester, you guys have to come up with your own trading strategy. You guys have to come up with your way to analyze the income statement, the balance sheet, the cash flow, blah, 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 all the data we talk about. So you come up with a theory first, and then you test it. How exactly we test it? So that's the way I was talking about, right? So I have the theory that short-term financing from suppliers, no good. Tax financing, not good. And you can test it. If I'm wrong, you see the results against your hypothesis and theory. So this is the this is the formula we have. This is the formula we have here, and so let's see what we have here. So operating growth is growth financed by vendors and suppliers. How do you calculate that? We use total asset growth minus growth financed by debt and equity, and minus by short-term financing, minus the tax financing, and then take the difference between everything. We will have the growth financed by the vendors and the suppliers for long-term assets. Let me repeat it one more time. Okay, let me repeat one more time. So we start with total asset growth. We start with total asset growth. We minus growth financed by debt and equity. We minus growth financed by vendor short-term financing. We minus by tax financing from government. We financing everything. We minus all this out. What's the left? The left is exactly growth financed by vendors and the suppliers for the long-term assets. So that's how we do the calculations. That's how we do the calculation. Like I said, when you read the paper, you can get the formula. You can get the formula, but I want you guys to understand the intuition behind the formula, how we come up with the formula. You should understand that we have 250 variables from complex data and the income statement. I hope you guys can understand how to use that to construct a useful signal to predict the future stock returns. Okay, and there's some measurement error. There's some measurement error on this calculation because when we do this formula, there's a chance that the operating growth from the formula may contain something else we don't know. So there's some noise component in the operating growth. So we did something in the paper. We're trying to validate our calculation is right. So how do we validate that? The way we validate is we want to see the operating growth is positively correlated with customer and supplier growth. So the idea here is if the operating growth calculation is correct, if the firm has a new customer, we should see the growth financed by customers should rise as well. So there must be a positive correlation between new customers and the growth financed by customers. So that's how we validate that. That's how we validate that. So in other words, we worry about operating growth. The calculation of operating growth have some noise components, which will kind of make the calculation inaccurate. So we want to validate that our calculation is correct. The way we calculate it is we want to see that when a firm has a new customer, would growth financed by suppliers and customers, would that be actually increased? Will that be increased corresponding to when the firm has a new customer? So we want to see there's a positive correlation between firm has a new customer and the asset growth financed by customers. And do the same thing when the firm has a new suppliers. We want to see that the measure we calculated also increase with the firm having a new suppliers. So this is how we validate this measure to make sure the measure is correct. So this is the intuition. This is the intuition about the formula, how we calculate the growth financed by vendors and suppliers for long-term assets. So let's look at the test, the empirical test, to see whether it works. So you can see that. So you can see that. So you can see that the operating asset growth, operating growth predicts the future earnings. So basically, asset growth financed by vendor and suppliers predict the future earnings. And then what we see here is the financing growth. The growth financed by debt and equity is negatively predicting future asset earnings. So you guys see the difference, right? That's why this is good growth, this is bad growth. The growth financed by vendors predict future positive earnings. the growth financed by the equity and the debt predict negative future earnings. You see the good growth and negative growth. Okay, let's look at these two variables. This is suppliers short-term financing. This is government tax financing. You see that it doesn't load. It doesn't load. Does that confirm what I just claimed? Does that confirm what I just claimed? Earlier I was saying, suppliers short-term financing maybe useless because this is short-term. So the data speaks themselves, right? When you predict the future earnings, it does not have a significant relationship with future earnings. Same as the tax financing. The tax financing also do not have significant relation with the future earnings. So that kind of confirms what I said from early slides. That's why we need to take out the short-term financing from suppliers and the tax financing from the government. So to summarize, what do we learn from this table? What do we learn from the table is we have a good growth. The good growth is asset growth financed by vendors and suppliers and customers for long-term stuff. We have bad growth. Bad growth is the growth financed by the equity and the debt. And we have the vendor short-term financing. It doesn't matter. It doesn't matter. It predicts nothing. We have a tax financing. It predicts nothing as well. So that's why we have a good growth here, and we have a bad growth here. That's the first test. We want to make sure theory-wise, we test the theory, make sure that's correct. And we'll keep moving. We want to do the short-term test. We want to do the short-term test to see if it also generates returns. So what we found is when we use these to predict the annual return, the return is about 4%. So the good growth can predict 4% of annual return in next year. And how about short window? This is a 12 days return. I forgot, this is 12 days or 3 days. Anyway, this is short window return. This is about 1%. So in a several days window, you have 1% return. For annual window, you have a 4% return. So you see that what's comfortable? What comfortable is most of the return are actually from the short window. And I told you guys why we like a short window return. Think about it. You buy and hold the stock for 3 days, comparing you buy and hold the stock for 200 trading days. Which one you would prefer? I would prefer buy and hold for 3 days. For 3 days, there's less events, there's less drama, there's less risk. If I hold for 200 trading days, a lot of things can happen. We may have another COVID-19 coming in the next 200 days. So you never know, right? You never know. The longer you hold, the more risky events may happen in the future. So that's why we prefer we can obtain the return from shorter window rather than the annual window. So you can see that the results shows that for the annual window, most of the return, it's 1 divided by 4 is 25%. So what does that mean? That means if you trade the stock around earnings announcement, you can get 25% of return from your annual buy and hold. So that means 25% of return can be realized just by buy and hold around earnings announcement, 3 days around earnings announcement. That's beautiful. That's beautiful because it's less risky. It's less risky. So so this is the things we just talked about. In the last class, I keep emphasizing how to predict the signal you have here is something you know, other people don't know. How do you know the signal, the operating growth can predict earnings? And this is the signal you know about, other people don't know about. I said 2 steps. The first step is you use that to predict the future earnings. It's positive. And the second step is you use it to predict future returns. if everybody know this one can predict the future earnings, you won't see the operating growth predict the future stock returns, because we can see that the operating growth can predict future stock returns. That means you are the one of the few guys know about this. A lot of people do not know about this. So when do they know? They know about this among the buy and hold in the following year. They know this in the following earnings announcement. That's why you can buy the stock based on the operating growth. And when do you realize the returns? You realize the returns when the future earnings is announced. You realize the return when you buy and hold for the subsequent year. So because you are the one of people know the signal, so you know the signal ahead of other market. So that's why you can buy the signal and use that to predict the future stock returns. But in case you don't see the significance here, so in case the operating growth cannot predict the future stock returns, that means what you know also is known by other people. Okay, that means what you know is also known by other people. So that's the I'm keeping emphasizing this again and again, so you guys understand how we form the trading strategy, how to test whether the one strategy is tradable or not. Yeah, and you can see that after control for other variables, so the signal, the positive growth predicts 5%, 4% annual return, and the positive growth predicts 1% return around earnings announcement. And we like the percentage. The 1 divided by 4 is 25%. We like that. We like that. This is empirically, it supports this is a good growth. Supports this is good growth. And yeah, this is stuff. So another thing is we want to show this is not driven by risk. You know, I keep emphasizing that you have to make sure the 4% and 1%, it's tradable profit, is not risk. It's tradable profit, not risk. We have to do a lot of stuff to make sure that's the case. So the first approach we do is adjust for risk. So you can adjust for size, you can adjust for the book to market, you can adjust momentum, liquidity, you can adjust for a lot of risk factors. So the idea here is once you adjust for all these risk factors, if we still have an alpha there, that means this is not driven by those risk. If it is driven by some tradable profit, that's one way we are doing that. But you know that there's one problem is you only can adjust risk. Maybe there's like 1 million risk there you don't even know. That's what I discussed the first class, right? So how do you make sure? How do you know you can adjust for risk you don't even know? For example, COVID-19. Do you even know about COVID-19? That's not on your list. That's not on your list. So how do you make sure the profit, the 4% and 1%, it's still tradable? Even you adjust for stuff, for the risk you don't even think about. So we have several ways. I will discuss. We have several ways to do that. The first is short-term window. We just discussed, right? The short-term window. If you have a high percentage return from short window, that's more confident. That gives us more confidence. In our case, it's 1% over 4%, so 25% from short window. It's very strong pattern that the profit can be obtained in 3 days around the earnings announcement. So short window can give you guys the confidence this is tradable profit. It's not risk because there's less risky event among the short window. That's one way you do it. Another way we do that is look at the declining pattern. So let's look at the table here. Let's look at table here. We adjust for risk. We can do that, adjust for risk for short window. So let's look at the table together. So look at it. The positive growth can predict the following earnings announcement, and for the next following earnings announcement, it's a weaker result. For the third earnings announcement, no result. Fourth earnings announcement, no result. So what does that mean? That means the investors can, so that means, okay, let's go back to the story. The story is, you know the operating growth, it's a good signal. Other people doesn't know. That's your assumption. So when you see in the following earnings announcement, you realize 0.4% return. That means other people takes 3 months to know what you know. And then in the next earnings announcement, we have a returns. That means in the following 3 months, people are still learning what you know. What do you know? But in the 9 months, there's no return. That means what? Means in the next 6 months, people already get what you know. So in the 9 months, there's no return. There's no return here. And in the 12 months, there's no returns here. So that means what? It means it takes 6 months. It takes 6 months for investors to know what you know. It takes 6 months for investors to understand operating growth. It's a good signal, can predict the future positive returns and earnings. That's why we want to see a decline pattern. That's why it is a decline pattern, because decline pattern consistent with the story we have. When you see a decline pattern, that's like I said, that means the investors takes 6 months to learn what you know. Takes 6 months to know the operating growth. It's a good signal to predict the future. In the 9 months, there's no return. The reason because no return, because they already know that. It only takes 6 months for them to learn. That's the story here. So let's look at the other case. What if it's significant here, significant here, significant here, significant? What if the whole 4 quarters, the subsequent quarters, are all significant? What does that mean? That means the investors takes forever to know what you know. It does not make sense. It doesn't make sense. If you see the significance continuing in the future, that means this is not about information you have. That's about the risk. There's a risk there. The risk keep predicting the premium in the future, significant. That's the story behind. So that's why we want to see a declining pattern here. That's one declining pattern here. When we see a declining pattern, that means you know something other investors do not know. And it takes 6 months for investors to know that this is a good growth, if you see a declining pattern. However, if you don't see a declining pattern, if you see significance over the 4 quarters, you cannot interpret as investors take 1 year or take forever to know what you know. It's impossible. Investors will know what you know eventually. If you see the significance over the future quarters, that means it's not about the information you have. It's about the risk. It's about the risk continuing associated with future risk returns, premiums. So that's why we want to see a declining pattern over the future quarters, over future years. Just to put it simply, if you see the declining pattern over future periods, that's good. That means you know something other people doesn't know. If it's continuing to be significant, that's a risk. That's considered a risk. So this is the ways how we distinguish between the tradable profit and risk. So you can adjust for the size, momentum, blah blah blah, a lot of things. One approach, you can do the short window. You can see the declining pattern. That's all a method we use to make sure this is a tradable profit, not risk. We have to be serious, right? This is about money. This is about money. You want to make sure the profit you gain, it's profit, not just random gambling. You don't want to gambling. As a finance students, you don't want to gambling. What you want is rigorous data analytics and generate tradable profit. Okay, and also what else you can do? What else you can do to so what else you can do to show this is a profit, not risk? There's other things you can do to show this is a profit, not risk. One thing is you can look at the analysts. You can look at whether stock analysts also do not understand the pattern you see, because you want to show that you want to prove there's something you know other people don't know. So how do you observe other people don't know? One group you can observe is stock analysts. So you can see that if stock analysts do not react to the information you have, that means there's a good chance the market didn't know something you don't know. Does it make sense? Let me repeat it one more time. So the idea here is you want to prove you know some information other people don't know. For example, you want to prove operating growth is a good growth for the future. You want to prove that's the information you know. Other people have not realized it yet. So how do you observe other people? One group of people you can observe is stock analysts. So you can look at the stock analyst forecast. If stock analysts do not incorporate the information you have into their forecast, that means you are knowing something analysts do not know. If you are knowing something analysts do not know, there's a good chance you're knowing something the whole market do not know. That's the idea. Okay, that's the idea, to show this is the trading profit, not risk. This is one approach. This is one approach. Another approach, what you do is, one approach is you show by the story. What's the story? The story we have is when vendors have more information about the firms, they will know the firms well, and they will not allow the firms to do bad growth. So another test that you can do is, if the vendor knows the firm more, would you see stronger positive return in the future? If the vendors know the firm less, would you see less positive returns in the future? So another way you can test is, you can test your theory using different scenarios, because the story is what? The story is because the vendors know the firms, the vendors do not allow the firm to do bad growth. So we can test that by looking at how much the vendor know about the firm. If the vendor knows about the firm a lot, then we should see stronger positive growth. Because if the vendor knows the firm a lot, if the vendor finance the firm, that means this is good growth, really good growth. But if the vendor doesn't know the firm that much, just know a little bit, this kind of vendor financing maybe just very weak positive, very weak positive. So these are the different ways. These are the different ways we can rule out whether this is a tradable profit or the risk. So not just by short-term window, not just by declining pattern. This is what we talk about the slides. So we introduce two more ways to rule out risk. One way is look at whether the information you know, whether do analysts know that. If the information you know, analysts do not know about it, there's a good chance all other people doesn't know. This is approach one. The second approach is you look at whether when vendors have more information about the firm, did you see a stronger positive growth? If the vendors know a little bit about the firm, did you see a weaker positive growth? So that's another way to test whether this is risk-driven or luck-driven or profit-driven. So this is different ways you can test. You can differently test. So the bottom line here is trading strategy is a no joke. We don't want just you touch your head and saying, okay, I can make money. You don't want to do that, okay? You have to do a very rigorous way to rule out this one work. It can generate a profit. It's not by luck. It's not gambling. It's not you are just too overconfident about self. So the bottom line here is form a trading strategy is a no joke. You have to do a lot of rigorous check on whether the profit you claim is driven by the real tradable profit or something else you don't even know about. So you have to do a very rigorous data analytics to make sure this is an implementable trading strategy.